Welcome back to the deep dive. It is Wednesday, January 25th, 2026, and we are looking at a stack of documents that just dropped this morning from Ally Financial.
We are. The Q4 and full year 2025 earnings.
And, looking at the headline numbers for their full year 2025, it really looks like a victory lap. But when you actually read the transcript, it feels, a lot more like a high wire act.
That's a very fair assessment. On the surface, that victory lap narrative, it holds up. Adjusted EPS earnings per share is up 62% year over year.
62%.
For a regulated bank, that is just a massive jump.
Right, hitting $3.81 per share for the year. And they beat expectations for the fourth quarter, too. But here's my skepticism right out of the gate.
Okay.
They're calling this a strategic refresh. And usually when I see a bank post a huge profit jump while talking about a refresh, it just means they fired a bunch of people or sold off the furniture to make the quarter look good. Is this sustainable, or is it just financial engineering?
It's a bit of both, but maybe not in the cynical way you're thinking.
Yeah.
This wasn't about selling furniture to pay rent. It was more about realizing they had way too much furniture in all the wrong rooms.
Mm-hmm.
The CEO, Michael Rhodes, who's been in the seat for a full year now, he basically decided that trying to be this universal digital bank was just killing their efficiency.
Because they took a hatchet to some pretty major business lines in 2025. They completely sold the credit card business.
And stopped originating mortgages altogether.
Yeah, that's what I mean. So isn't that incredibly risky? We always talk about how diversification is the safety net for these guys.
It is.
So if you sell your credit card arm and you stop mortgages, you're effectively betting the entire farm on the auto market. If Americans stop buying cars, or if that loan market craters Ally has, nowhere to hide.
You've just hit on the central tension of this whole report.
Yeah.
They are trading that diversification for what they call intensity. They looked at their data and just realized, they weren't winning in cards or mortgages. They were just participants. But in auto, they're a dominant player.
So the argument is, why prop up a mediocre business?
Exactly. Why spend capital supporting a so-so mortgage business when you could deploy that same dollar into a new auto loan that's yielding 9.7%?
Okay, let's talk about that capital part, because this is something I want to unpack. In the presentation, they made a huge deal about improving their ROTCE.
Return on tangible common equity.
Right, that one. It jumped 300 basis points to 10.4%. I feel like companies just throw this acronym around to confuse us. Why does cutting a business line improve that specific number?
This is a really critical piece of the mechanics here. So ROTCE is a fraction. The top number, the numerator, is your profit. But the bottom number, the denominator, that's the equity, the capital you have to hold to keep regulators happy and cover any bad loans.
Okay.
And businesses like mortgage servicing and credit cards are super capital intensive. They require a really big denominator.
So by getting rid of them, they just shrank the denominator.
Drastically.
Yes.
So even if your profit stayed completely flat, just shrinking that denominator makes your return on equity go up.
I see.
But in this case, their profit also went up because they stopped losing money on operational costs for businesses they just weren't very good at. It's denominator management. They're getting more bang for their buck with every dollar of equity they hold.
So they cleaned house, they're leaner, but now they are so reliant on the engine room, as they call it.
Dealer financial services,
Yeah.
auto loans.
And the volume here is just wild. 15.5 million applications in 2025.
A record number.
But here's what I don't get. If you have 15.5 million people begging for a loan and you're trying to grow, why did they only originate $43.7 billion? That sounds like a lot, but relative to the applications, they're rejecting a massive amount of business.
They are. And this is the whole discipline part of the story. If they had accepted everyone, sure, their revenue would look explosive right now, but their losses in 2026 would probably bankrupt them.
So they got picky.
Very picky. Instead, they focused on what they call the S tier.
Which implies there's an A, B, and C tier below it.
Exactly. S tier is their highest credit quality.
Yeah.
Super prime. 33% of their entire loan volume came from this top bucket. These are borrowers who almost never default.
Okay, but here's the kicker.
Yeah.
Even with that high credit score, Ally is originating these loans at yields of 9.6 to 9.7%.
It's painful for the consumer. Can you imagine having perfect credit and still paying nearly 10% on a car note?
It's brutal.
It's the reality of the rate environment we've been in. But for the bank, it's a gold mine. And this brings us to the concept that is driving their entire profit model right now. They call it the vintage rollover.
I saw this term all over the transcript. It sounds like a wine tasting or something.
A little bit, yeah.
Yeah. But I'm assuming it's just portfolio churn. My question is, loans always roll over, old ones get paid off, new ones get written. Why is this specific rollover such a big deal for Ally right now?
It's all about the spread, the gap between the old and the new. Think about the loans they wrote back in, say, 2020 or 2021.
When interest rates were at rock bottom.
Right. So those loans are sitting on Ally's books, earning maybe 4 or 5%. They're basically asset drags.
Okay.
But car loans are relatively short, 3, 4, 5 years. So right now, in early 2026, a huge chunk of those low-interest pandemic loans are finally expiring or getting paid off.
And every time one of those 4% loans disappears,
They replace it with a brand new 2025 vintage loan that's earning 9.7%.
so it's a velocity issue. The replacement rate is almost double the expiring rate.
Precisely. The portfolio is naturally, you could say, healing itself. The average yield of the whole thing is climbing quarter by quarter, not because the Fed is hiking rates, but because the bad vintages are washing out.
And because they're shifting to that S-tier customer, credit losses are dropping at the same time.
Yes. They mentioned their retail net charge-offs, which is just bank speak for loans we had to write off as a total loss. That number dropped below 2%, 1.97% to be exact.
Which was a major goal for them.
It's the holy grail of lending, keeping charge-offs under 2% while your yields are going up.
However, it wasn't all perfect. And this is where I want to pause, because there was a very specific $11 million loss in the fourth quarter that I think tells a much bigger story about the economy.
Oh, yeah. The lease residuals.
On plug-in hybrid electric vehicles, or PHEVs, this was such a fascinating detail.
It's a perfect case study in asset risk.
Walk us through this, because
Yeah.
typically I think of a bank losing money because someone didn't pay their bill, but that's not what happened here, right?
No, the borrowers paid just fine. This is all about the value of the car itself. When Ally leases you a car, they are making a bet on what that car will be worth in 3 years when the lease ends. That future value is the residual value.
So they guessed the car would be worth, say, $20,000, and it came back and was only worth $15,000.
Roughly, yes. And specifically with plug-in hybrids, they just got hit by a perfect storm.
Okay.
First, government policy changed. Certain tax credits for EVs were eliminated or altered.
Okay, that's one hit.
Second, there was a recall from an OEM, an original equipment manufacturer, that really hurt the reputation of specific models,
And when you have a recall and no tax credit, demand just plummets.
which then forces the manufacturers to slash prices on new cars just to move inventory.
Mm.
And this is the part people forget. The moment the price of a new car drops $5,000, the value of every single used version of that car sitting in a garage drops instantly.
Because why would I buy a used one for $25K if the new one is now $28K?
Exactly. So the used market for PHEVs just collapsed.
Yeah.
And Ally was left holding these cars coming off lease, and they had to sell them at a loss compared to what they projected. That $11 million hit is a direct result of policy and manufacturing volatility.
It's a really sobering reminder. I mean, you can have the best credit model in the world, pick the best borrowers, but if the underlying asset, the car suddenly becomes unpopular because of a law change or a battery recall, the bank still takes a hit.
It creates a lot of nervousness about their pure EV exposure going forward, honestly. If the government changes the rules again, or if technology shifts, those residual values are just a complete moving target.
Speaking of moving targets, let's look at the macro picture. You've got CEO Michael Rhodes talking about optimism, says the consumer looks strong, but then you have the CFO, Russ Hutchinson, the guy counting the beans, and he seems to be hedging his bets.
Yeah, he explicitly said they are assuming unemployment will be higher in 2026.
There's a clear disconnect there, isn't there? Rhodes is looking at the internal data, people are paying their bills, deposits are growing, the soft landing seems real.
But Hutchinson is looking at the broader economic models, which all suggest the labor market have to crack eventually.
And you can see that fear showing up in their reserves. They're holding a coverage ratio of 3.75%. Now, given that their default rates are dropping, that NCO number we talked about, you'd usually see a bank release those reserves.
Take the cash and book it as profit.
Yeah, but Ally isn't doing that.
No, they're keeping it flat, which they call prudent stewardship, but what I would call healthy paranoia.
Meaning they just don't trust the current stability.
I think they don't want to get caught flat-footed. If Hutchinson is right and unemployment does tick up in mid-2026, they're going to need that 3.75% cushion. It implies they think the vintage rollover is great, but it might not be enough to outrun a recession if people actually start losing their jobs.
So they're hoarding cash just in case. But at the same time, and this is where I get confused, they're buying back stock. They authorized a $2 billion share repurchase program. That feels completely contradictory. We're worried about the future, so let's go spend $2 billion buying our own shares.
It does sound strange, but this brings us to what the CFO called the tyranny of or versus the power of and.
Sounds like a business school lecture.
It is, but it really applies here. Usually a mid-sized bank has to choose. It's, do we use our cash to fund new loans? That's growth. Or do we give cash back to shareholders? That's buybacks.
The tyranny of or. You have to pick one.
Because capital is scarce. But Ally is claiming they've crossed a threshold where their organic profit engine, that 9.7% yield, is generating so much cash that they can fund all that $43 billion in new loans and still have money left over to buy back stock.
The power of an and.
The power of and.
Though, to be fair, they are moving slowly. They called it low and slow. They've only bought back $24 million so far.
Which is tiny compared to the $2 billion authorization. It's a signal to the market. It's like saying, we have the ammo, but we aren't going to fire it all at once until we see what unemployment does.
Let's talk about where that money actually comes from. We focus on the loans, but a bank is nothing without its deposits, the liability side. They ended the year with $144 billion in retail deposits.
And 2025 was their 17th consecutive year of customer growth.
That stat is remarkable when you think about the timeline. 17 years takes you back through the pandemic, the regional banking crisis of 2023, the zero interest rate era. Through all of that, they never had a net loss of customers in a year.
They're up to 3.5 million customers now.
And 92% of those deposits are FDIC insured. You know, that number matters a lot more to me now than it did, say, 3 years ago.
It matters to everyone. It means their funding base is sticky. It's not hot money from hedge funds that's going to vanish overnight. It's regular people's savings accounts.
Okay, looking ahead to 2026, this is where I want to get a little technical because I think the why of their future profit really matters. They're guiding for their net interest margin, their NIM, to expand. It's around 3.5% now, and they want it in the upper threes.
This is the most critical part of their entire 2026 thesis. It all relies on something called liability sensitivity.
Break that down, because usually when the Fed cuts rates, which everyone assumes is going to happen in 2026, banks make less money.
For many banks, yes, but Ally's are different. So think about their balance sheet. On the liability side, their deposits, they have savings accounts. They can change the interest rate they pay you instantly.
Right.
If the Fed cuts rates by 0.5 point, Ally can drop their savings account rate by almost the same amount the very next day.
Okay, so their costs drop immediately.
Immediately. But now look at the asset side, the car loans. Those are fixed rate loans. If you took out a car loan yesterday at 9.7%, that rate is locked for 5 years. Even if the Fed cuts rates to 0 tomorrow, you still owe Ally 9.7%.
Ah, I see. So their cost of funds, what they pay me, it falls off a cliff. But their revenue, what the borrower pays them, that stays on a plateau.
Correct. The spread between those two, the net interest margin, it widens. That is liability sensitivity. They actually benefit when rates fall, specifically because their assets take a long time to reprice, but their liabilities reprice instantly.
So 2026 is just set up to be a perfect sweet spot. The Fed cuts rates, Ally's costs go down, their old vintage loans keep paying those high yields, and profits just soar.
That is the bull case.
Yeah.
That is the perfect spreadsheet version of reality.
But the real world has potholes.
It has massive potholes, and this is where we circle right back to that tension we discussed at the beginning. The entire plan works if the consumer keeps paying.
Right. If that vintage rollover is bringing in 9.7% loans, that's great math. But if the person holding that loan loses their job, the yield isn't 9.7%, it's 0.
Exactly. Or worse, it's a loss. That's why that little EV story is so important. It showed us that even if the borrower is good, the asset value can just crash.
So now imagine if the borrower isn't good because unemployment hits 5 or 6%.
Then you get a double whammy. You have defaults spiking, and when you go to repo the car to sell it, maybe the used car market has softened too.
And suddenly that strategic refresh where they put all their eggs in the auto basket looks less like genius focus and more like a dangerous concentration of risk.
It seems like Ally is betting on a soft landing more than almost any other bank. They are levered to it.
They've positioned the ship perfectly for it.
If the waters stay calm, they are going to make an absolute fortune in 2026. If a storm hits, well, they don't have the mortgage or credit card businesses to bail them out anymore.
So to wrap this up for you listening, if you're an investor, you're watching that net interest margin expand as the Fed cuts rates. That's the good news.
But you need to watch the delinquency rates like a hawk. Specifically, look for cracks outside of that S tier. If those 9.7% loans start going bad, the whole math falls apart.
And for the generalist, it's just a lesson in how interconnected this all is. A tax credit change in Washington, D.C. crashes the value of a plug-in hybrid in Ohio, which causes an $11 million loss on a balance sheet in Detroit.
And it forces a bank to pivot its entire strategy. It's never just about the numbers. It is always about the ecosystem.
2026 is going to be the year we find out if the vintage rollover can outrun the business cycle. It's going to be a fascinating race to watch.
I will be watching that unemployment rate every single month.
As will we. Thanks for unpacking all this with us.
Anytime.
And thank you for listening to The Deep Dive. We'll catch you on the next one.